our investors, and even for normal people, normal salaried people, on how to start saving and how to start investing during these times. And today I have a very interesting session with Kalpen Parikh from DSP Investment Managers. He's going to be speaking about a very interesting topic, which is Indians and the love for gold, and is it worth to buy it now? So we have seen over last few months that gold prices have increased, and a lot of people are interested in buying gold, and especially during these COVID times and recessionary seasons, there's a lot more interest in gold. And I think there is no better person to hear it from than Kalpen Parikh. So just to give you a brief introduction about Mr. Kalpen himself. So Kalpen is the president of DSP fund, and has been in the executive committee. He has over 19 years of experience, and he has heavy understanding of all the client segments, including distribution, marketing. He has also previously worked in all the top brands, which includes Birla Sun Life, IDFC, L&T, etc. So Kalpen, welcome to this series. It's been a pleasure to have you with us on this particular topic. And myself included, and even our viewers included, we are very eager to hear from you, and on your thoughts and on your opinions on gold and India's love for gold.
Thank you, Avinash, and the team at ClearTax for inviting me and DSP to talk to all your investors. And let me start with a disclaimer that I have been a non-believer in gold for almost 95% of my life. So if I am 46 right now, I think I'm 46. 43 years out of 46, I have never owned gold, except a very small wedding ring. And I used to always challenge and question the women at home. I have 4: grandmother, mother, sister, and wife. And I used to always question and challenge the need for gold, the need to invest in gold. Because I would say that I work in a mutual fund where we give you, very compelling investment options like equity funds and debt funds and hybrid funds and international funds. Why do you need gold? Of course, we also have a gold fund now to offer to our investors. But 43 out of 46 years, I never thought gold made sense. Having said that, I'm always open to challenge my own hypothesis, to look at data, and if data indicates that we should change our opinion and change our view for our hard-earned savings and money, so be it. And the next few slides are an indication of what type of data points made me revisit my view on gold as a part of a long-term portfolio done through monthly investment. I would still not buy gold one shot, but I would still buy gold like an SIP, the way I buy my equity funds or the way I buy my debt funds. So it's a very important asset class. One can question that, DSP does not have a direct gold fund. We have a very interesting gold fund. I'll talk about it later if required, but we don't have a direct gold fund or a gold ETF. Then why is the CEO of DSP Mutual Fund talking about gold? But so be it. It is a asset class which really gives a very interesting sort of mix to our overall portfolio. And let's, look at this. Gold is actually a very interesting asset class, and it has polarizing opinions. Typically we notice in investing, there are phases when everyone likes equity, or there are phases when everyone hates equity. There are phases when everyone likes bonds or hates bonds, likes real estate, does not like real estate. Gold is an asset class where at all points in time, there are duality of views. There are two different, points of view at all points in time. So if we look at Warren Buffett, who is, one of the most successful investor in the world with 79 years of experience and 16 to 17% compounding on dollar assets, superlative track record, and one of the richest investor. he has been very vocal, and he says that, I don't see value in gold because gold cannot generate cash flows.
Yes.
A bond or a fixed deposit can give us interest income or coupon, but
Yes.
gold does not give coupon. On the
Yes.
other hand, a stock gives us dividend yield, and a
Yes.
company whose stock you may own has earnings growth.
Yes.
Gold does not have dividend yield also, so there are no cash flows from gold, and hence he says that, as a financial investor, I do not like gold. On the other hand, you have Ray Dalio, who is founder of one of the most successful global hedge fund called Bridgewater Associates. uh, he has a very interesting observation, saying if you don't own gold, you don't know either history or economics, because gold at different points in time, when risk in traditional assets has gone up a lot, ends up reducing risk in your portfolio and also ends up enhancing returns in your portfolio. And his observation is right. At different points in time, when other asset classes do nothing, gold actually becomes a very successful asset class. So it's very important. And why am I highlighting both these perspectives to you, to all of you who are listening to me? Because it's your hard-earned money. Always look at both the pros and cons of any asset class or any investment decision that you're taking. Don't get carried away by what one person is telling you, because universe itself has duality. Life itself has duality. It's not binary. It's never either or. It's never, just one-sided view. If you want to be a good investor and if you want your portfolio to do well over time, always look for, both sides of the coins, both sides of the story, and then take a considered decision depending on what suits you. Now let's look at some data. What is the amount of gold, which has been mined? So the amount of gold which has been mined in entire lifetime is around 2 lakh tons, and one fourth of that, 25% of that, is still below ground reserves. So if one were to think of it that, can there be oversupply of gold? If at all you take out all the gold which is under the ground, it will still add another 25% of the stock which is there.
Yeah.
So just keep that data point at the back of your mind in terms of how much gold is today available in different formats. The formats are jewelry, that takes a large component. It's almost 50% of the gold which is floating around in the world. Another 22% is private investments. 17% is official holdings. So the consumption led usage of gold is almost 50% of the total stock of gold
Yeah.
which is available.
Yeah.
Look at another important data point. What do various central banks in the world think of gold? So while we may tell ourselves gold में पैसा लगाना चाहिए या नहीं लगाना चाहिए, what are the central banks of the world doing? So when you look at the holdings of the top 20 countries in the world, right from US to Singapore, all of them have significant amount of gold in their overall reserves. Somewhere like a US, which is the largest economy in the world, they have 8,000 tons of gold, which is a part of their reserves. Someone like India has around 600 tons of gold as a part of our reserves. So depending on the size of each country has some amount of gold in its balance sheet, in its savings, which is the foreign reserves that each one of them have. So, and also the trend that in the last few years, a lot of them have been increasing their purchase of gold. Now, people who like gold, why do they like gold? Actually, if you look at it, gold does not have excess supply. Today, if you look at bonds, central banks around the world can just print one key on a computer and create another $1 trillion worth of debt or cash in their ledger account,
Yeah.
and issue new bonds,
Yeah.
and hence create newer and newer supply. On the other hand, you cannot print a button, or you cannot press a button or print gold or create gold out of thin air, and that is what creates scarcity of gold. So like we saw in the earlier slide, roughly 2 lakh metric tons is the total stock of gold. And if you were to actually put it together in one place, it will actually be one baseball field or one entire football field will actually store all the gold which is available in the world. So that's the uniqueness about gold. It's finite in quantity. It does not come in excess supply. And we all know the equation of demand and supply. What is finite in quantity becomes precious. Why is gold called precious? Not because it can shine and it looks good and so on and so forth. It's precious because it's less. Anything which is less automatically becomes precious. Number two, gold has durability. You can bury gold 50 years back and today and come back 50 years later, it will still be there as it is, almost unchanged. And the same has been true had our forefathers kept gold somewhere. They had dug up earth and put some gold there.
Yeah.
After even thousands of years, we go back, it will remain as it is. So
Yeah.
it has durability in it. It does not lose value. And that's again one of the reasons why it's called precious. And
Yeah.
then it has malleability, which means it can change form, it can change shape. The same piece of metal can be shaped into any format that we may want to look at. Now the next point is very important. What is the size of various asset classes
Hmm.
that we are traditionally used to investing?
Yeah.
So if you look at the size of equities, we are all popular with equity as an asset class. That's $75 trillion world over.
Hmm.
So
Hmm.
all the wealth of the world which is into equity as an asset class is $75 trillion. All the wealth of and then that is almost equal to the size of the economy. So the entire GDP of the world, if it is $70 trillion, roughly that gets represented in the valuation of all equity markets, which is almost the same. The
Yeah.
size of bonds in the world is roughly $250 trillion. Actually, it's now gone up to 280. It was 250 till some time back, but it's actually, it's around 250, $260 trillion. In the last 3 months alone after COVID, all central banks have actually printed another $10 trillion worth of, stimulus and liquidity.
Yeah.
The size of all real estate in the world is $300 trillion. The size of all foreign currencies is 350 trillion, and the size of derivatives is 1,000 trillion. In that context, gold is only 10 trillion. So a lot of people who are believers in gold say that even if 5% of any of these asset class swing happens towards gold, the demand for gold can be 50% of what is the size of the market today in different formats. And that can create a significant amount of demand for gold at some point in time if any of these other constituents in the world start turning volatile or start getting challenged or start getting questioned. So if you have to decide what are the investment checklists for any asset class to cross through for us to say that, okay, my money deserves this asset class, the first factor has to be fundamental, the second has to be behavioral, and third has to be technical, which is demand and supply. So these are the three factors which collectively determine whether one should invest or not in gold. Now fundamentally, gold has a very strong correlation with real interest rates. So whatever are real rates, interest rates minus inflation, if real rates go up, um, gold prices will go up. If real rates go down, gold prices can go down. Behaviorally, gold gives a lot of security because of its durability and because of our ability to really preserve its value and save it. And technically, it's demand and supply which determines how each of this can play a role. Now look at where is it in the cycle. In the last 18 months, while other asset classes have not done well, equity, real estate has disappointed most people in the world. Gold prices have actually gone up from $1,200 to around $1,800 while we talk today. So that's almost a rise of 50%. And that's the beauty of gold. When other asset classes don't perform is when gold does well. Of course, the flip side to this is when gold does not perform, other asset classes do well. So any asset class in isolation doesn't help. We have to have all of them in our cricket team if we
Yeah.
want to build a successful investment portfolio. Now,
Yeah.
if you look at the historical perspective, actually, even in spite of the last 18 months rise by 50%, in the last 10 years, gold prices in dollar terms have gone nowhere. If you look at it, even today at $1,800, gold prices are just where they were in the year 2011 and 12.
Yeah.
10 years, they've given no returns. So gold also can, punish us, testing our patience for
Yeah.
long periods of time when it may give no returns at all. However, why in the last 10 years has it given no returns? Because in the prior 10 years, which is 2000 to 2013, if you look at that in the second chart
Yeah.
here, it shows that gold had gone up from almost $300 to close to 1800. So 6 times. That's 600% rise.
Yeah.
And then again, for the last 10 years, it has gone nowhere. Now, in the next 10 years, will it go up? Will it be sideways? Will it go down? I don't know. But just be aware that it can have long periods of rise and then long periods of going nowhere. So when you make investments in any asset class, be aware that every asset class can have long cycles of giving no returns and short cycles of giving all the returns. And which is why timing these asset classes is not very easy. You have to have a balance of each asset class in the portfolio. So if you look at it, in the last, so we saw the last 20-year journey of gold. But if you look before that, from the year 1980 to 2000, again a long period where for 20 years in dollar terms, gold actually went nowhere. If you see from $650, it actually came down to $300. So it halved in price. So if you were owning gold in this phase, you would feel good that, okay, you have some gold with you, but actually the price went nowhere. And then, this is actually how gold used to move. It used to remain constant for long periods of time till 1967, when the whole gold standard was reset, and from $35 it straight away got reset to around close to $800, then went nowhere, and again it started its upward journey. So it's a very unpredictable asset class, and if you look at it over really long periods of time since 1950, that's almost 70 years of data. In these 70 years, overall in dollar terms, gold has gone up by 5.7%. Now if you add 3% of rupee depreciation to this return, it will end up giving around 7.5 to 9% return over a long period of time. So effectively, the returns of gold tend to mirror the long-term returns of fixed income or of debt, but gold performs when other asset classes don't perform. So it's like, you are in a cricket match, and when your top order is back in the pavilion, the top 6 batsmen and your all-rounders have, lost their wickets and they are back, and then the 7th or the 8th guy who's unexpected to deliver comes in and actually, becomes a match winner. And typically that's the value of gold during volatility. So, if you look at it on a decade to decade basis, every decade, these are the returns. In dollar terms, again, a decade of 70s, gold gave around 2.5% return in dollar terms. So you can add another, 3% return to this. And these are real gold, real return, which means returns above inflation, which is very valuable. In the next decade, it was almost 9%. The decade of 90s was bad, where it actually, earned much lesser. It actually gave negative returns. It took away your capital. And likewise, in the last 2 decades, it has given some positive, return. Just one second. Yeah. Now, for an Indian investor, what actually works is that in India, the advantage is not only do we make money from the change in gold price, but we also make money from the depreciation. So generally, our currency has always been a depreciating currency. And in that context, we can add another 2 to 3% return to the return that gold offers us. So factors that, so if you look at it this way, in the 1980 to 2000, bearish phase for gold prices, Indian currency significantly depreciated. On the other hand, 2000 to 2010 was a bullish phase for gold prices. Indian currency was stable. Last decade, 2010 to 20, gold prices gave moderate returns. However, the currency depreciated significantly. So what I mean to say here is that even if dollar gold prices were bearish in these 20 years, but you could make significant returns from currency depreciation. 7 to 41 is like a very long, the currency depreciated almost 4 times over. And likewise, in the last decade, 40 to 75, so currency depreciation adds up to the moderate return that gold prices would have given. And in rupee terms, if we look at gold returns in India, it's almost 12% since 1964, since the time the gold standard was abolished, which is a very, healthy return. Having said that, it has long periods of volatility, and that is sometimes unnerving. Now, what we have done here is we have tried to see what is the partnership of equity and gold. Now, we have data since 2005 for Nifty and then for gold. So if you see in the first 8 years, the blue line is the line for gold. It went up almost, 6 times, 5 times. 1,000 rupees became almost 5,000 rupees here. However, in this phase, equity from 2008 till around, here 2014 went nowhere. So these were periods of 6 years of no returns from equity. Now, in this period, if you notice, gold prices went up almost from 2000 here to 5,000 here. So they went up 2.5 times. However, in the next innings, Since 2013, if you notice here, gold prices have gone till here, till recently, till 2019, gold went nowhere. However, equity took over from here. From 2012, equity markets have been moving reasonably trending upwards. So, this is in a way a pair of Sehwag and Tendulkar. There are times when Sehwag will score centuries and Tendulkar will get out very fast, or vice versa. Now, if you see in the last 1 year, what has happened is equity markets have crashed and gold prices have taken off. So they are inversely correlated to each other. So gold gave 14.2, Nifty gave 12.7 in the last 15 years. But if you blend them, the average return is around 13%. However, the blended line looks far more stable. If you see, the volatility and the fluctuation of gold as an asset class is much higher than the blended line. The fluctuations of equity as an asset class is also higher than the blended line, but the blended line itself is far more stable and can significantly cushion volatility. So if you have to look at gold, look at it as a very appropriate portfolio diversifier, as a safe haven against a lot of macro risks which are increasing in recent times. Because in the last 10 years, what has happened is, world over, all central banks have inflated the amount of debt which is floating around in the money in the world, amount of debt floating around in the world. They are constantly printing new currency. They are creating paper currency, and that paper currency is being used to solve economic problems. But fundamental economics says that someday this will stop, and the day central banks stop printing money, equity markets could actually fall. And in that phase, gold can protect. On the other hand, if central banks continue printing money, that also is a strong reason, because that would mean depreciating currencies in various emerging markets. So country like India, which is an emerging market, country like India, which has very high inflation, gold can act as a very beautiful hedge against two of our biggest problems. Two of our biggest problems as a country are, we are inflationary in nature, and our rupee tends to depreciate structurally at most points in time. So gold can act as a very good hedge, and actually gold can give significant upside in some moments when rest of the monetary system or economic system goes through significant turbulence and can collapse. So that's one of the reasons why gold can act. And like I said, I also changed my opinion about gold 3.5 years back, because in 2017 and 18, when I was evaluating where do I put my money, in 2017 the 10-year government of India bond was at 6%. So the whole hypothesis was that if you want to put money in bonds, earlier you were getting 9%, 10%, now it's come down to 6. If you want to invest in equities, again in 2016-17, Indian markets were very expensive, equities were on a high side. So I said that if both these asset classes are very high, gold for the last almost 7-8 years has gone nowhere. Let me start adding some amount of gold. And through a product called Gold Mining Fund, I started gradually doing monthly SIPs, not knowing that 2020 will be a year when gold prices will go up and equity prices will come down. So that is something very difficult to predict, when will it go up, but it truly protects. And I can tell you that in the last 3 months, large part of my overall portfolio has been positive, even in the month of March, because when everything fell by 30%, gold was up by 40-50%. And that acted as a very beautiful hedge to the portfolio. Now, what are different options through which one can park money in gold? One is jewelry. So you have physical options, which is jewelry, biscuits, gold coins, and so on and so forth. Then there is, paper gold, where you can invest through exchange traded gold ETFs. You can invest through gold bonds. It's a very interesting proposition that the government of India launched 2-3 years back, where it earns you 2.5% return, which is what you earn in your savings account also. And then over and above that, whatever is the differential in gold price between today and 5 years later or 8 years later, that is the return that you will earn. So gold returns, the difference in gold price plus 2.5% interest is what you earn. But of course, the flip side here is that the money is locked for 5 years. There are lock-ins of 5 years, and liquidity yet is not very well proven or well tested. But if you have a 10-year, 20-year view of having gold as a diversifier in the portfolio, it's a very interesting option. And then you can invest through, again, gold fund of funds. And then the next lot is gold mining companies, which is a more sophisticated way of investing. This is a more volatile way of investing. So my way of investing in gold is, through these two components. I invest through the sovereign gold bonds, and I invest through the gold mining company. So these are companies which actually mine gold. So whenever gold prices go up, these companies, their stocks go up by 1.5 times. For every $1 of rise in gold price, the gold mining company stock goes up 1.5 times. On the other hand, vice versa, when gold prices drop by 1 rupee, the gold mining company stocks also drop by 1.5 rupee. So it has higher amount of volatility, higher amount of beta. So not meant for investors who want less volatility. But if you understand the space, if you do your research, it's something that you can evaluate. So there are multiple formats in which one can invest in gold, and it's always wise to diversify. As households in India, jewelry and physical gold is anyways a very traditional way of saving gold. I would advise you to look at these two newer ways, unconventional ways also of adding gold to the portfolio. What are the flip side of gold? Unlike equity mutual funds or buying stocks, liquidity may not be completely easily available. There is always tracking error. Taxation is not favorable. So these are few things that you should be aware of. So in a nutshell, I believe, let me finally summarize by explaining to you that if you were the central bank of US or the central bank of Germany or the central bank of Japan, these are the three large economies where interest rates are zero. So if you were investing in any of these three economies in bonds there, the bond, when you buy a bond from a company, they will give you a piece of paper, but they will give you no return over the next 10 or 20 years because interest rates are at zero. So in that sense, bonds, which globally used to yield 3 or 4 or 6% return in the last 20 years, that return has become zero.
Yeah.
So till now, one used to argue that why should I own gold? Because gold does not give cash flow, but bonds give cash flow. If I own bonds, I will earn 3%, 4%, 5% dollar returns. But if I buy gold, I will not earn any of those cash flow returns. Today, that argument has got neutralized because even when you own bonds in US or in Germany or in Japan, which are all zero interest rates, or in Switzerland or most of the developed economies, even on bonds, you're earning zero. So the threshold barrier, one would always say that if I have to invest in gold, it will happen only after it earns me a return higher than what interest income is. So today the threshold for both has become zero. And which is why there is a heightened interest to have gold in the portfolio. And lastly, like I said, gold cannot be printed out of thin air, whereas bonds can be printed out of thin air. And in that construct, gold can be a protector of value. But keeping the volatility in mind, which is, like I showed you, this is the type of volatility. The best way to invest in gold is using SIPs. What I mean is invest every month as a part of your monthly investment, and maybe invest a lot more when last 5-year returns of gold is poor, and invest a bit less when the last 1-year return of gold is very high. So for example, the last 1-year return of gold is very high. However, right now we are in a very interesting phase where 1-year return is very high, but 10-year return is still zero. So, hence I feel that from a timing point of view as well, gold becomes a very relevant asset class. So that's it from my side. Over to you.
Great, Kalpin. It was a very interesting conversation from your end. So I have a lot of questions. I think our viewers also have a lot of questions.
Sure.
So we would like to take some questions, and it would be great if you could share your opinion with that. Kalpin, yeah. So Kalpin, so there are a few questions from I think Naresh Kotari has a question here. He wants to know, in future, will the gold price increase or decrease? And there are a few others also who are asking the same question. He wants to know in the future if gold price will increase or decrease. So what's your opinion on that?
So my view is, like I highlighted, see, when you ask about the price of any asset class, any commodity, whether it is equities, whether it is gold, whether it is real estate, there are always three outcomes. The outcome is price can rise, price can fall, or price can go nowhere. These are the only three outcomes, and all three will be a part of your investing journey. My hunch is, and I'm not an expert on gold, so to say. Like I told you, I've started studying a bit about it only in the last 3 years. My hunch is that the time is apt to have gold in the portfolio because whether gold prices go up or not, there is a reasonable probability that a lot of currencies could lose value. A lot of currencies could have significant depreciation in their value.
Yes.
because of the way the global macro setup is, where, as I said, in the last 10 years, central banks have constantly printed a lot of money, and the
Yes.
entire monetary system can
Yes.
actually see significant volatility. And
Yes.
in those moments, if
Yes.
those currencies fall by 20%, and if gold even remains as
Yeah.
it is like a 20% gain.
Yeah.
Uh, Let me give you another example. In the decade of 1920 and 30, when there was a large recession in the world and in US, most of the
Yeah.
blue chip stocks in US dropped by 80% in value.
Wow.
A
Mm.
lot of us should study history
Yeah.
in investing more than forecasting future and looking at astrology. The
Yeah.
study of history is more valuable. So every phase when economies have been confronted with large, long periods of uncertainty and volatility, gold as a asset class has actually protected and given returns. I
Yeah.
believe that uh, gold has reasons to go up
Yeah.
uh, in the future, and hence I'm here talking to all of you.
Yeah, great. I think there was also one slide which was very interesting from you. Was that at least in India, the whether it was either through the currency depreciation or whether gold price rising in dollar terms itself, the gold price kept rising through the years, and you could see almost 12% CAGR in gold. And I think some of my friends in stock market also say that gold and Sensex have sort of given similar returns over last 20-25 years. That's interesting. Also, I have another um, uh, question from one here called Manish Rati. He says that the gold price as of today is at all-time high, and do you think it would be the right time to get in now, or what are the risks that you have to consider before you get in? So that is one of the questions.
Yeah, so like I said, while on one hand gold prices are at a lifetime high, but there are two ways to look at it. They are still where they were in the
Yeah.
year 2012 and 13. So they've just crossed their 7 year past peak. It took
Yeah.
them 7 years to just recover the value, and
Yeah.
maybe they could see a different trend. So don't look at gold with a short term, like any other asset class. When you invest in equity also as an asset class, don't look at it with a
Yeah.
1 year, 2 year view,
Yeah.
and don't let it be a very large part of the portfolio where even if for the next 3-4 years gold prices go nowhere, it should
Yeah.
not hurt you, it should not pinch you. So have reasonable amount of moderation in the exposure that you take.
Yeah.
And what can go wrong, what is the downside, is that, see, gold does well when there is very high inflation. But if world over inflation does not come back, if the world continues to remain in deflation or very slow growth environment and very low inflation,
Yeah.
if inflation is low, generally then gold tends to underperform in those phases. But in that
Yeah.
environment, then equities will end up doing well. See,
Yeah.
some of these are very long range predictions, which
Yeah.
the human mind presumes that it can predict. But the truth is, we cannot predict. I cannot tell you, honestly, if you had asked me in the year 2000, what would I be doing in
Yeah.
2020, I couldn't have predicted. So,
And
directionally, what we know is in the long run, equity markets will go up. Um, Directionally, we know that whenever equity markets is sideways or downwards, gold prices go up. And that's the data that we have shown you in the last couple of slides.
yeah.
Now, equity markets have run up a lot in the last 10 years,
Yeah.
notwithstanding the correction that happened in the month of March. But
Yeah.
even today, markets have risen from there significantly.
Yeah.
And in the global setup also, US markets are at their lifetime high. So at
Yeah.
some stage when equity markets, resume their consolidation phase,
Yeah.
is when gold will do well.
Yeah.
So, like personally, I have around 15% of my savings in gold, of
Mhm.
which around 10% is through the gold mining fund and 5% is through sovereign gold bonds.
Got
Um, so, there is no science behind why 10 and why 5 or why not the other way around. But basically, both give me an exposure to gold as an asset class. And whether I should make it to 20 or keep it to 10, I don't know. There is no science to convey that. But I do know that this 15% helped me a lot in the
Yeah.
month of March not to lose my cool, not to lose my sleep, and not to touch my portfolio.
Yes.
Had all my portfolio been in equities and
Yeah.
that would have been down 40, my temperament would have provoked me to redeem some money.
Yes.
And I would have redeemed that. And then in April, May, and June, that portfolio is up again another 35%. So
Yes.
gold acts as a very good defense, and hence it should be a part of the portfolio, not just about the direction in the next 1 or 2 years.
Yes. So the next follow-up question, I think, is on one of the aspects that you touched upon. So for Indians, they have a lot of choices in when it comes to gold. I think most of us have seen gold jewelry. That could be one form of investing, but yeah, when you actually go and sell your jewelry, you get a discounted price. There's also bullions and other physical forms of gold like coins, etc. And I think right now you see also digital gold coming in. A lot of tech platforms have started putting in digital gold, but all of these platforms, when you buy gold through that, you have like 3% GST tax that come over it. And then you also touched upon new forms of paper gold, which is ETFs and SGBs. I think you personally yourself have SGBs. So at what point and what should investors buy? Maybe there are different investors having different views. So who should buy what? Like what would your suggestion be? What would your advice be?
So
I think
why?
SBPs also come with 5 years of lock-in, and they give you a little bit of interest rate. So how should investors start looking at this and different forms
Yeah, I
of buying?
think one thing to keep in mind is, let's say, let's look at this reality. If you look at
Yeah,
the amount of gold which is available
yeah,
is 2 lakh tons,
yeah,
and there is only 25% of that which is there if you want to create new gold.
yeah,
Now, if some part of this money, either
yeah,
from currencies or from bonds or from equities,
yeah,
moves, or from derivatives, moves towards gold
yeah,
through a financial instrument like a gold ETF,
yeah,
what could happen is that the ETF receives lots of flow. It
yeah,
receives, let's say, billions of dollars,
yeah,
and it goes into the market to buy physical gold, because the ETF has to be backed with physical gold. It can't not have a backup.
yeah,
So when it goes to buy physical gold, you can't print physical gold out of the blue,
yeah,
and there can be some amount of shortages and dislocation that can happen because of that.
yeah,
So, to be on the safer side, what I would do is I would say that, okay, where is gold backed by the sovereign? So the
hmm,
sovereign gold bond
yeah,
uh, is a risk I'm taking on the government of India and
yeah,
the bond of government of India,
yeah,
and the return of that is just going to be the price difference between the two.
yeah,
I'm unlikely to face an issue like that. So
yeah,
that becomes one part of my portfolio.
yeah,
Uh, Physical gold automatically becomes another part of our portfolio, whether through jewelry or through biscuits or through bullion,
yeah,
because as a culture we are used to own gold and pass it on to next generation. So I won't talk about it. It's already a part of every household.
yeah,
Uh, so why do I look at incrementally the sovereign gold bond? Because it's backed by the sovereign, backed by the government of India. It's a scheme by government of India.
mm-hmm.
And the second reason why do I look at gold mining stocks or
Hmm.
gold mining funds? Because it's easy to get in and get out.
Got
I can press a button and 3 days I get my money back.
got
I
it,
don't have to worry about the making and making charges, the leakage, the GST, and so on and so forth.
got
It
it,
is like buying the stock of any company. So if oil prices go up, or if pharma prices go up, healthcare stocks will do well. Likewise, if gold prices go up, these stocks will do well. So I can actually get in and get out with far higher ease. And if I hold it for more than 3 years, then even the taxation is conducive with benefit of multiple indexation. But if I hold physical gold, in
yeah,
physical gold, I don't have the advantage of advantageous taxation. So
yeah,
these are reasons where I prefer. So my traditional exposure to gold as a family will be whatever my parents or my wife or in-laws would have picked up or kept. And my new way of adding to gold is the sovereign gold bond and the gold mining fund. But it's good to diversify across all of them and not be only in one bucket.
great, got it. So another follow-up question is, I think you mentioned that you had like 15% of your savings in gold. What would you suggest for the investors in terms of what percentage of allocation should they give in their portfolio for gold in these times? And yeah, so what would your suggestion be?
Okay. So I think, it's not wise for me to give a single answer, because every investor has different time horizons, risk appetite,
Yeah.
overall portfolio journey. So my portfolio journey can be very different than all of you who are listening to me.
Mm-hmm.
And then honestly, there's no scientific work done by anyone in the financial world to
Yeah.
say whether 15% is right or 50% is right.
Yeah.
But my framework would be that, I would always look at the Nifty to gold ratio.
Yeah.
And in a cycle, if Nifty has gone up very well,
Yeah.
then in that phase, incrementally, I will buy more of gold.
Yeah.
And in a cycle where gold has run up a lot over the last 5 or 10 years, then
Yeah.
I'll slow down on my gold investments, and I will prefer to buy more of Nifty, or more of equities, or equity funds as I invest in. So,
Got
if let's say gold prices were to fall in the next 6 months or 1 year or 2 years, I would not hesitate to take it to at best 25%.
got it.
And beyond 25%, then you are putting up too much of risk on one single asset class.
Yeah.
And if that asset class does not do well, it hurts your overall portfolio return a lot. So
Got
my personal bias would be 15 to 20%.
it. Mm-hmm.
If it falls down, I'll go to 20. If it rises a lot dramatically, then maybe I'll take it down to 10%. So
Yeah.
my bias is whatever rises irrationally,
Yeah.
you reduce exposure to that.
Yeah.
And whatever crashes irrationally, you
Yeah.
increase exposure to that.
Yeah.
Now, so the exposure to gold also should be seen in context to other asset classes.
Yeah.
If let's say interest rates in India go to 12 or 13% because of some currency crisis and bond yields go up,
Yeah.
then I would like to put most of my money in debt,
Yeah.
because 13% return in debt or 12% return in debt, and that was possible in the year 2009 and 10,
Yeah.
when because of the currency turning weak, or it was possible in the year 2013 when bond yields went to 10%.
Yeah.
So that is a time I would not chase gold.
Yeah.
I would chase an asset class, Government of India bond giving me 10% CAGR every year. I'll allocate more in that.
Yeah.
Or there are times when the yield on equity goes to 10%. So there are times when, if the stock market P goes to 15 times,
Yeah.
which means if you take the reverse of 15, 100 divided by 15, that's almost 6.5, 7% yield on
Yeah.
equity as an asset class.
Yeah. Yeah.
Today, that yield is only 4%. So if
Mhm.
that yield doubles to 8%, plus there is dividend yield of 2%, if
Yeah.
you're getting 10% yield from equity as an asset class, then I will not chase gold. I'll rather go to equity. So I think it has to be looked in conjunction with these parameters. And, uh, the best advice would go from an advisor who understands each customer very well. But this is the framework I would try to apply.
Great, great. Yeah, I think even I was you had talked about Buffett and Ray Dalio. I think Ray Dalio also said that have at least 10% in your portfolio in these times. So that's interesting to see that you are willing to go up to 15-20%, and depending on the investors' risk, they can go up to whatever they feel is good. The last question I have, Kalpesh, is one thing. People want to understand, how do gold funds work, especially they want to know, so how does DSP gold fund work, and how does gold funds in general work, and is that a good asset to have from
Yeah,
gold?
so a mutual fund vehicle is, like I said, a very convenient vehicle for you to not worry about all the intermediate steps of owning gold. You don't have to really keep custody of that gold. You don't have to worry that घर में gold पड़ा है, तो is it safe or not. All those issues are taken care of when you are investing it through a mutual fund vehicle.
Yeah.
And particularly, you asked about how does the DSP gold fund work. So we have a fund which is called DSP World Gold Fund. It is a fund which is managed by BlackRock, our erstwhile joint venture partner. So this is a fund which invests in lot of companies in the world. Some of these are Canadian companies, some of these are American companies, some of these are Australian companies. These are companies that are miners of gold. They are the ones who mine gold.
Got it.
And what happens is that either there are phases when the demand for physical gold goes up, but the amount of gold that you can mine is only going to be finite. Hence, the price of gold will go up. So generally, the cost of mining and cost of operations and cost of production for gold mining companies is around $1,200.
Yeah.
Any gold price above that straight away goes to profits.
Yeah.
So if gold prices are $1,500, then $300 per turn becomes straight away a profit for that company. And mining gold is not easy. So, relatively, there will be less number of companies in that space. New capacity creation is not easy. So, if these are good companies with good managements and, good governance, then you are getting a dual advantage of not just taking advantage of gold prices, but also taking advantage of the financial leverage that a business can have. So these are companies where you'll have, 1 rupee of equity capital, 3 to 4 rupees of debt capital. So effectively, you're putting 5 rupees of capital. So that financial leverage also works in your favor. The flip side to this is it works the other way around if gold prices were to crash. So if gold prices go below $1,200, what happens is a lot of these companies start making losses. And when the sector starts making losses, many companies shut down. Only the strong companies survive. And those who survive become very big winners in the next cycle. So what happens, one of the reason why I have been investing in the DSP World Gold Fund is 2 years, 3 years back, like I showed in one of the slide, for the last 8-9 years, gold prices were below 1,200 or stagnating there. So a lot of weak companies went out of business. So what was left is what is captured in the World Gold Mining Fund, in the World Gold Fund. So you're buying the survivors.
Got it.
Then you have to be patient that someday when the cycle turns, these are the survivors who will generate maximum profits or maximum profitability. I was seeing someone shared a very interesting data point with me that, today the most fashionable space to put money is NASDAQ, all the tech companies, the FANG stocks, and, so on and so forth. And these are great companies, great business models who have created humongous value for investors and for the world itself, whether it is Apple or Alphabet or Microsoft or Google or Netflix or Amazon. They all, and plus many other digital companies, they are all represented by NASDAQ. Now, in the last 10 years, NASDAQ has given the best returns. But if you plot returns from the last gold cycle around 25-30 years back, since that time till today, some of the gold mining stocks have given better return than NASDAQ also. So the point I'm saying is timing becomes very important. Buying these companies at the bottom of a cycle is very important. So I would say that, we are still, coming back to where gold prices were 8-9 years back. Invest in gold through SIPs till the time, equity markets become cheap. The day equity markets and fixed income becomes very cheap is when you can go back and, of course, even today I'm saying that largely, like my personal portfolio allocation is almost, 45 rupees in equities, around 40 rupees in bonds, and 15 rupees in gold products, gold mining companies. So you still have a large component in equity. So when I'm saying that look at gold, it is not coming at the cost of equity. Don't get me wrong that sub equity bech ke gold mein dal diya. Don't make that mistake. There have to be multiple pillars for your long-term financial wealth. Gold is one of the pillar apart from equity and bonds. So that's my suggestion.
Great. Thanks, Kalpen. Very, very interesting discussion, especially much needed in these times when people are actually looking at these prices and thinking what to do and how to do it. I think you gave a very clear answer on a lot of aspects, and it was very clear with me on how should I take my decisions going forward, what should I look into, what are the risks, and what are the different forms of gold that I have available, and what should I do with that. So very interesting discussion, Kalpen. So thanks from ClearTax and from our viewers also. We are very pleased that you were part of this series, and we would definitely like to get you back sometime later and discuss about different aspects of investing. Thanks a lot, Kalpen. Thanks a lot from ClearTax.
Thanks, Avinash and ClearTax for inviting DSP and myself. All the best to all of you. Thank you.
Thank you. Thanks a lot.